afternoon, ladies and gentlemen. Central Bank of Nigeria, Communique number 84 of the Monetary Policy Committee meeting of Monday and Tuesday, July 23rd and 24th, 2012. The MPC met on July 23rd and 24th, 2012 with 11 out of 12 members in attendance. The committee reviewed the economic conditions and challenges in the first half of the year against the backdrop of developments in the international economic and financial environments with a view to considering the monetary policy options for the remaining part of 2012. The global economy. The committee noted the continued fragility of global economic recovery and the increased downside risks to growth in 2012. In particular, the sovereign debt and financial sector problems, together with recession in the UK and some Eurozone countries and reduced growth rates in the US, continue to affect China, India, and Brazil's export-driven growth. This has necessitated a downward review of the projected global output growth for 2012 by the IMF in July 2012 WEO update. While the effort to fix banks and sovereign balance sheets by the European Central Bank using long-term financing operations eased funding constraints and broadly rallied the assets markets, these gains were short-lived due to the intensification of policy uncertainty after the Greek and French elections, strong dampening effects of the financial fragility in the euro area peripheral states, and public resistance to austerity measures. In the advanced economies, the weakness in the labor and housing market, the elevated debt levels of households, and the need to fix the encumbered balance sheets of banks are likely to continue to constrain growth prospects. Consequently, growth forecasts in the advanced economies was downgraded by 0.2 percentage points to 1.4% in 2012 relative to the April WEO estimates. In the United States, output growth was revised slightly downward to 2% from 2.1% by the IMF in the report. In the euro area, GDP growth is expected to contract from an annual rate of about 1.4% in 2011 to minus 0.3% in 2012, with France, Italy, and Spain leading the contraction in growth. The revised growth rate of 1% for Germany in July is an improvement of 0.4% over the April 2012 IMF growth projections. In the United Kingdom, real GDP growth was projected at 0.2% against the initial projection of a contraction of 0.4%. Spain's latest round of austerity measures failed to reassure investors and markets as the country's borrowing costs continue to rise. In emerging economies, the lag effect of past policy tightening has continued to weaken internal and external demand, thereby limiting growth. In China, real GDP growth slowed to 7.6% per year in the second quarter of 2012, compared with 8.9% in the fourth quarter of 2011, due mainly to weak external conditions, particularly sluggish demand from the euro area. Real GDP growth forecast for 2012 has been reduced to 8% from earlier forecasts of 8.2%. India's real GDP growth moderated to 5.3% year-on-year in the first quarter of 2012, compared to 6.2% in the fourth quarter of 2011, with the projection for 2012 put at 6.1% compared with 7.1% in 2011. Output performance in sub-Saharan Africa is projected at 5.4% in 2012. While exports to Europe have dropped, strong terms of trade and increased trade diversification towards emerging markets have helped support growth in the region. A major issue, however, is that inflationary pressures and reduced fiscal space present limited flexible policy options for maneuver, especially if downside risks materialize. Overall, the slowdown in global economic activities would have serious implications for the Nigerian economy in the following respects: a softening in the demand for oil and consequent decline in oil revenues, reduction in foreign exchange earnings, which would impair the buildup of external reserves and consequently exert pressure on the exchange rate, increased budget deficit as the government will not be able to realize its revenue projections, and increased public sector borrowing to finance expenditure outlays. Output and prices. The revised GDP growth rate projected by the National Bureau of Statistics for Q2 2012 at 6.37% was higher than the Q1 2012 level of 6.17%, indicating increased momentum in the economy. Overall GDP growth for 2012 was projected at 6.38%, down from the realized growth rate of 7.74% in 2011. The projected decline in growth is attributed to a number of factors, including the estimated loss of about 207.41 billion naira in national output during the nationwide strike in January, the dampening effects of low crude oil demand from major trading partners, falling oil prices, weak aggregate domestic demand, and slower growth in agriculture. The non-oil sector remained the major driver of growth, recording 7.52% increase in contrast to the oil sector, which contracted by 0.24% during the period. The committee noted with concern the sustained slowdown in the growth in agricultural output of 4.08% in the second quarter compared with 4.15% in the first quarter, traceable to the continued security challenges which affected a large part of the farming population in the northern parts of the country during the period. The committee also expressed serious concerns over the continued decline in the contribution of oil to GDP, which became apparent from the second half of 2011 and intensified through Q1 and Q2 2012. Its contribution to growth declined by 0.4% apiece in the third and fourth quarters of 2011 and declined to 0.4 and 0.04% in Q1 and Q2 2012. There are serious concerns over continuing fiscal leakages, bunkering, and oil theft in the Niger Delta area. This notwithstanding, the committee was pleased to note that the growth projections were against the backdrop of severe weaknesses in the global economy. Thus, domestic output was anchored by the positive impact of the banking sector reforms, as well as initiatives by government to stimulate real economy, such as improvement in national electricity generation, which rose 2,900 megawatts as a result of the increased gas supply to the thermal stations, increased water level at the hydro stations, and the resuscitation of some dormant generating stations. The committee noted downside risks to growth in the near term, in particular the fall in the average spot price of Nigeria reference crude, the Bonny Light, from $121.1 in the first quarter of 2010 per barrel to $109.32 per barrel in the second quarter, and the current security challenges which continue to pose a threat to agriculture and manufacturing. Prices. The committee noted the threat of inflationary pressure, which has re-emerged since the beginning of 2012. The year-on-year headline inflation rose to 12.9% in June against 12.7% in May. Core inflation rose to 15.2% in June from the 14.9% in May, though food inflation declined from 12.7% in May to 12% in June. The major drivers of headline inflation during the period were food and non-alcoholic beverages and housing, water, electricity, gas, and other fuels. The acceleration in core inflation in the second quarter was traced to increases in the contributions of processed food and housing, water, electricity, gas, and other fuels. The committee noted that in addition to the lag effects of the partial removal of the petroleum subsidy in January, other factors fueling the upside risk to inflation in the near term include borrowing by government to cover large fiscal deficits in the 2012 budget and the upward review of electricity tariffs and import duty on wheat and rice in July 2012. Money, credit, and financial market developments. Broad money grew by 1.35% in June over the level of end December 2011, translating into an annualized 2.7% growth, which was lower than the growth rate of 10.77 year-on-year. Relative to December 2011, aggregate domestic credit declined by 2.73% in June 2012, annualized to a decline of 5.46%. Although overall credit to the private sector increased by 3.6%, the committee noted that credit to state and local governments grew by 14.23% or 28.46% on an annualized basis. Credit to the core private sector grew by only 3.2% or 6.4% when annualized. The committee noted that rates in all segments of the money market trended upwards between May 21 and July 11, 2012. Retail lending rates remained high in June, as the average maximum lending rate remained unchanged at 23.44%. On the other hand, consolidated deposit rate fell marginally from 3.83% in May to 3.82% in June. External sector developments. Gross external reserves as of July 19, 2012 stood at $37.16 billion, representing an increase of $0.33 billion over the level of $36.83 billion at end May 2012. The exchange rate at WDAS spot opened at 157.26 naira and on May 21 and closed at 157.43 naira on 12th July 2012, representing a 17 kobo or 0.11% depreciation during the period. The committee noted that the premium between the rates at WDAS and Interbank and between WDAS and BDCs narrowed towards the end of the review period, and therefore urged the bank to sustain existing measures to discourage speculative demand in the market. During the period, the naira weakened to as low as 163 naira to the dollar due to developments in the external economy, and the CBN had to intervene significantly in the interbank market to restore stability. The committee's considerations. Against the backdrop of the foregoing, the committee observed that monetary policy faces a difficult task in terms of delivering price stability. Domestic conditions indicate rising unemployment, poverty, declining growth, and rising inflation. Consequently, the money and foreign exchange markets appear to be operating at suboptimal levels. He noted that with weakened global outlook underpinned by slowdown economic activities in the US and major emerging economies like Brazil, China, and India, contraction in output in the euro area, along with persistent debt crisis, which is proving difficult to resolve, lower demand for crude oil and lower crude oil prices, coupled with the lower domestic output growth, build-up of inflationary pressures, slowdown in the accretion to external reserves, and the attendant pressures on the exchange rate, as well as possible shortfall in the projected revenue for 2012, the ominous signs for the domestic economy are evident. In this regard, therefore, monetary policy is faced with very difficult choices, as whatever action taken must be weighed against the possible trade-offs and implications for the wider economy. The committee further noted that the inflation environment remained uncertain, with the possible pressures coming from the core component in the medium term. Domestic inflation has maintained its upward trend and is expected to remain within that region over the next 6 months. More so, the committee observed that since its meeting in May 2012, growth prospects continue to be threatened by developments in Europe, China, India, and the US, as well as the very slow progress in structural reforms and poor implementation of the capital budget for 2012. The committee observed that during 2008 and 2009, when oil prices declined sharply and the domestic currency came under intense pressure, the CBN was able to defend the naira because the nation had buffers, having accumulated substantial foreign exchange reserves when oil prices were high, but that this time around that luxury does not exist, as the excess crude account has largely been depleted and is still being depleted by the 3 tiers of government. The committee also noted that the upside pressure could be further exacerbated by pressures in the foreign exchange market in view of the high demand in the market and the likely impact of the decline in international oil prices on the country's external reserves. The committee therefore identified a number of key concerns that it was confronted with. 1. Stemming the inflationary pressures arising from both domestic and external sources. 2. Sustaining a stable exchange rate for the naira. 3. Creating a buffer for the external reserves. And 4. Mitigating the impact of the continued slowdown in the global economic activity, particularly in the US, Europe, and China, on the Nigerian economy. All this in the face of a slowdown in GDP growth. In the committee's view, these challenges would persist in the medium to long term, with attendant consequences to all receipts. The committee noted fears about Europe's debt crisis, which flared recently, as concerns intensified that Spain would be next in line for a government bailout. Thus, the MPC is confronted with basically 3 choices. First, lower the MPR in the face of sustained slowing domestic output growth and concern about growth prospects. The MPC viewed that a lowering of the rates in the face of sustained slower growth of output and global growth prospects could further weaken the exchange rate and adversely affect reserves at a time when the country needs to build up buffers against external shocks. It also reiterated its view that the growth challenge is a result of poor record of implementation of structural reforms and the capital budget. Second, to leave the MPR unchanged, and this against the background of upward trending inflation figures and the precarious picture painted by the 6 months inflation forecast of the bank, revised upwards since the last MPC meeting in May. Inflation is expected to average 12% during the next 6 months, with core and food inflation being much higher. The forecast is mainly due to increase in electricity tariffs and the tariff on imported rice and wheat. The committee recognized, in considering the third option, that a logical response to the increasing inflationary outlook would be an increase in the MPR, especially considering the impact of sustained liquidity in the banking system on exchange rates. It was, however, conscious of the impact of higher interest rates on small businesses and the potential for higher non-performing loans on the books of banks. In addition, it is important to leave room and flexibility for further tightening should conditions so warrant in the near future. However, it is important to note that the significant liquidity on the books of banks has not led to intermediation and lending to the real economy. Banks have continued to take advantage of high yields and government securities to direct credit away from the core private sector. In addition, the liquidity has provided ammunition for speculative activity in the foreign exchange market, with implications for inflationary expectations. Against the foregoing, therefore, the MPC reiterated the need to choose a policy trajectory that would have the least negative impact on the wider economy, to the extent that the longer-term benefits of the economy far outweigh the short-term costs. It was therefore imperative to reduce the liquidity in the banking system while minimizing the upward movement in MPR. The committee's decisions. In view of the foregoing, the committee decided as follows. 1. Retain the monetary policy rate at 12%, with symmetric corridor of plus and minus 200 basis points by a vote of 10-1. One member voted to reduce the MPR by 25 basis points to 11.75%. 2. The committee voted by 10-1 to increase the cash reserve requirement from 8% to 12% with effect from July 25th. One person voted to retain the CRR at 8%. 3. The committee unanimously agreed to reduce the net foreign exchange open position to 1% from 3% with immediate effect. Thank you. If there are no questions, I think we should just close.
No, there is.
Thank you, Governor Wale Famarewa, CNBC Africa. Can you just speak more to the concerns you have around the risk that the economy is faced with? Because many will argue that the decision to tighten further by raising cash reserve ratio is putting the economy, or rather putting business, increasing the cost of business significantly.
Well, you know, we did say that we had a very difficult decision. This is one of the most difficult MPCs in recent times. You have a slowdown in growth. At the same time, you've got very strong inflationary pressures. The central bank has to continue to focus on price stability. And while controlling inflation is not everything, certainly if we lose stability, then there will be nothing. We already are dealing with structural problems. We're already dealing with issues on the fiscal side. We do not want to compound this matter by having a high rate of inflation. Now, one of the major concerns we have is that if you look at what's happening in Europe, in the United States, in China, in India, and Brazil, you cannot rule out the possibility of a decline in the price of oil. And if you have an external shock to reserves, and a major depreciation of the currency, that is going to feed into an already existing inflationary spiral. And that would be unacceptable. So it's actually better at this moment to tighten money supply, tighten liquidity in the banking system, try to build up those buffers, and prepare ourselves for the storm that will definitely come.
My name is Idris Ahmed. I report for Electro. I would like you to review some of all the programs, intervention programs that central bank needs. It's part of this. It's part because the governor said that reviewing the economy, there are certain areas to measure, especially rising unemployment, and some of those interventions was made to bring about employment. Now, looking at the situation, the economic situation now, would you say that those interventions have worked, or are there areas that you want to review?
I think you should leave that for another time. You can ask that question outside this forum, and we can give you details of the results of those programs.
Okay, Governor, my name is Oyiwachwa for Business Day newspaper. Governor, you raised the concern that despite significant liquidity in the books of banks, they are still averse to lending. We want to know why is this, and is the CBN handicapped? Is there nothing the FX Bank can do to remedy the situation? Thank you.
Well, you can't really compel banks to lend. You can create an environment in which lending takes place, and some of that is not just monetary policy. Lack of progress on the structural side has been a big problem. Obviously, if you don't have power, if you don't have infrastructure, you're not likely to get very good manufacturing counterparties, and banks will not find small businesses to lend to. On the other hand, if you've got a very strong record of fiscal spending, and that has led to tight monetary policy and high rates of interest, you have a natural crowding out effect, because the banks simply find it easier and more profitable to put money in government securities than to start looking for customers to lend to. So part of the solution, obviously, is to reduce that liquidity, take some of that away, because that liquidity has been used for speculation in the foreign exchange market and for this crowding out effect for small businesses. We'll have to continue working on structural reforms. We have to continue working on moral suasion. We have to continue doing things like NERSL and working on the cultural transformation initiative. And those are the things that will open up other areas of the economy and hopefully create opportunities for banks to lend to those areas. Last question.
Thank you, Mr. Governor. My name is Matthias Okud. In fact, my question borders on what you just said. We are not economists like yourself. We would like you to tell us, we would like you to expatiate more, Mr. Governor, on how this raising of CRO cash reserve ratio would really influence or attract lending to private sector. I ask this question because I'm concerned because the power sector still cannot attract lending because a document prepared by the CBN, which I stumbled on, said that banks are not really lending for the power sector. What is happening? And Mr. Governor, if you would also maybe you want to share with us how much you have really disbursed from the power sector from time to time.
Okay, I'm not going to discuss the CBN interventions because this is a matter that's been discussed at several fora. And if you want details on that, you can always get from our development finance team. We can have our corporate communications talk to you about it. On the CRR, the reason for increasing it was not primarily about redirected lending. It was primarily about contribution to stability. At the moment, if you look back what happened a few weeks ago, we had a lot of pressure on the exchange rate. And the only reason we're able to keep the Naira stable was because we tightened money and also increased the amount of supply from the reserves of dollars. We cannot continue to run down reserves in order to have a stable exchange rate. And in the event of the slowdown in Europe becoming very serious and hitting all prices, what will happen is that we're going to have so much pressure on reserves we may have to rapidly depreciate the local currency, and that would feed into an existing inflationary loop. So the primary concern is our price stability concern, which is the primary mandate of the central bank. And if we have very high inflationary expectations, we should take measures to address structural excess liquidity in the banking system. And that is what the CRR increase is supposed to achieve. It will not address all the problems facing the economy. Somebody has to provide power, somebody has to provide infrastructure, somebody has to provide security, somebody has to provide the right tax and tariff regime. All we can do is, for our own bit, try to make sure that inflation and exchange rate do not go out of control while this is being done. Thank you.
You gave us information that our external reserve showed an increase, and within the week we also got information that the excess crude account registered an increase also. But when the exchange rate fell, there are still concerns because the naira in exchange to other currencies are still on the high side. What is the projected comfort zone in terms of the setting of buffers for external reserve, and what are the expectations maybe in the next months ahead in terms of our exchange rate?
Well, I mean, we have tried to keep the exchange rate stable, and even when we had external shocks a few weeks ago, we were able to restore stability in the foreign exchange market. How firm the naira remains will depend largely on the net flows to reserves. If we have a massive decline in the price of oil and a massive shrinkage of reserves, there's going to be a limit to how much we can continue to protect the naira. We've got to allow some mild depreciation and controlled adjustment in the value of the currency. The excess crude has built up, but I'm aware that the governors have asked for $2 billion out of it. So that build-up is probably going to be reversed very soon. You've already seen the pressure on the government to improve on implementation of the budget, so we should see some additional government spending the second half of the year. All of these are going to add pressure to reserves and to exchange rates. So it is a big challenge. It is a difficult situation, which is why we've taken the very difficult decision now of increasing CRR significantly in order to make the conditions a bit more amenable to stability. Thank you.